Accrual accounting. It sounds complex, doesn't it? But let's break it down together, because understanding this concept is like having a secret key to unlocking the financial health of any business. Whether you're a seasoned professional, an aspiring accountant, or someone just curious about how companies manage their money, getting a grasp on accrual accounting is crucial for navigating the financial landscape. First things first, let's talk about what accrual accounting really is. Imagine you're running a business. You sell a product to a customer, and they promise to pay you later. In cash accounting, you'd wait until that cash hits your bank account to recognize the sale. But in accrual accounting, you recognize that sale the moment you make it, even if the money hasn't come in yet. It's all about timing, and it's a game changer for how we view a company's financial position. So why does this matter? Well, accrual accounting gives us a more accurate picture of a company's financial health. It ensures that the financial statements reflect the true performance of the business during a specific period. This is where the principle of matching comes into play. It's like a dance between revenues and expenses. You want to match the income earned with the expenses incurred to generate that income, all within the same accounting period. This way, you're not just looking at what cash came in and went out, you're seeing the whole story. Let's illustrate this with a simple example. Picture a company that sells shoes. They sell a batch of shoes in December, but don't get paid until January. Under cash accounting, they wouldn't recognize that revenue until January when the cash arrives. But under accrual accounting, they recognize the sale in December, aligning it with the period when the shoes were sold. This gives a clearer picture of how well the company performed in December, which is essential for stakeholders who want to understand the business's actual performance during that time. Now, let's dig a bit deeper into the role of accruals. These are the adjustments we make to financial statements to account for timing differences between when transactions occur and when cash changes hands. Think of accruals as the bridge that connects cash flow timing with revenue and expense recognition. They help us capture the economic reality of a business. For example, if a company provides services in December but receives payment in January, accrual accounting allows the company to record that revenue in December. This way, the financial statements reflect the reality of the services rendered, providing a more accurate representation of financial performance. But what about the implications of all this on financial statements? Accrual accounting has a profound impact on how we view a company's profitability and financial health. By ensuring that revenues and expenses are matched correctly, we avoid distortions that could mislead stakeholders. Imagine a manufacturing company that incurs significant production costs in one period, but doesn't get paid for the products until the next period. Without accrual accounting, that company's profitability would look skewed, and stakeholders might draw incorrect conclusions about its financial health. Timely recognition of revenues and expenses is another critical benefit of accrual accounting. It allows businesses to present a real-time picture of their financial performance. For instance, a consulting firm that provides services in December but invoices in January can still recognize that revenue in December. This timely recognition gives stakeholders a clear understanding of the company's performance during that month, even if the cash inflow occurs later. Now let's talk about decision-making. Accrual accounting empowers investors, creditors, and other stakeholders to make informed decisions based on reliable information. When they review financial statements prepared using accrual accounting, they can assess a company's ability to generate future cash flows and evaluate its long-term sustainability. This is crucial for making investment or lending decisions. After all, you want to know if a company can keep its doors open and thrive in the long run. Moreover, accrual accounting promotes comparability. When companies consistently apply the accrual basis of accounting, their financial statements become more comparable over time and across different businesses. This comparability allows stakeholders to identify trends and patterns, making it easier to benchmark a company's performance against industry standards or competitors. It's like having a scorecard that helps you understand where a company stands in the market. And let's not forget about regulatory compliance. Accrual accounting is not just a best practice, It's a requirement under many accounting standards, such as GAAP and IFRS. By adhering to these standards, companies demonstrate their commitment to accurate and reliable financial reporting, fostering trust among stakeholders. This trust is essential for maintaining the integrity and credibility of financial information. Now, let's circle back to the decision-making aspect. Accrual accounting is like a crystal ball for decision makers. It helps them recognize revenues when they're earned, which gives them insights into the company's revenue-generating capabilities. For instance, a software company might recognize revenue as it completes project milestones, even if the client hasn't made the full payment yet. This real-time understanding of revenue streams allows decision makers to adjust sales strategies and pricing effectively. Matching expenses with revenues is equally important. Accrual accounting helps decision makers understand the costs associated with generating specific revenues. By accurately associating expenses with their respective revenue streams, companies can make informed decisions about cost management and evaluate the profitability of different business segments. Imagine a manufacturing company analyzing the cost of producing a particular product. With accrual accounting, they can assess profitability based on the revenues recognized in the same period. Accrual accounting also provides valuable insights into operating cash flows. By recognizing revenues and expenses when they occur, decision-makers can analyze the timing and magnitude of cash inflows and outflows more accurately. This understanding is crucial for effective cash flow management and planning for future liquidity needs. For example, a retail business that sells products on credit can analyze customer payment timings to make informed decisions about inventory management and credit terms. Realistic forecasting and budgeting are other advantages of accrual accounting. By recognizing revenues and expenses in the period they're incurred, decision-makers can project future financial performance more accurately. This helps in setting realistic goals and developing strategic plans. For instance, a hospitality company can forecast future revenues by considering bookings and historical data, allowing for effective resource allocation and marketing initiatives. And let's not overlook the importance of transparency and reliability. When companies adhere to accrual accounting principles and standards, they ensure financial reporting is transparent and consistent. This transparency fosters investor confidence and trust in the company's financial statements. For stakeholders, having access to reliable financial information is crucial for making timely decisions about funding or investment opportunities. In conclusion, understanding accrual accounting is essential for anyone managing a business. It equips you with the knowledge to decode financial statements and gain insights into a company's true financial position. Accrual accounting ensures that income and expenses are matched with the period in which they're earned or incurred, providing a clear picture of profitability and financial health. If you're looking to optimize your financial reporting processes, consider seeking expert services to navigate the complexities of accrual accounting. With the right guidance, you can ensure your financial statements present a true and fair view, empowering stakeholders to make informed decisions that drive business growth and success. So, whether you're an accountant, a business owner, or just someone curious about the world of finance, remember that accrual accounting is your ally. It's the framework that helps you see beyond cash transactions and understand the real story behind a company's financial performance. Embrace it, and you'll be better equipped to navigate the financial landscape with confidence.